Section 6. Asset bubbles and market inefficiencies. Herding behavior can lead to asset bubbles. These occur when asset prices rise significantly above their intrinsic value. Herding drives demand and inflates prices. When the bubble bursts, it can lead to market crashes and significant financial losses. Market inefficiencies arise when prices do not reflect true value. Herding contributes to these inefficiencies by distorting supply and demand. Investors buy assets not based on value but because others are buying. This can lead to mispricing and unstable markets. Asset bubbles can have severe economic consequences. They can lead to financial crises and economic downturns. Understanding the role of herding in creating bubbles is important for both individual and institutional investors. It helps in making more informed investment decisions and avoiding market pitfalls.
Section 7. Increased volatility and reduced diversification. Herding behavior increases market volatility. When many investors buy or sell simultaneously, it leads to large price swings. This can create an unstable market environment. High volatility can be risky, especially for individual investors. Herding also leads to reduced diversification. Investors may put their money into popular assets, ignoring diversification principles. This can increase risk, as portfolios become heavily weighted in a few assets. Diversification is key to managing risk and achieving long-term investment goals. Volatility and reduced diversification make markets less predictable. They can lead to significant financial losses, especially during market downturns. Understanding the impact of herding on volatility and diversification is crucial. It helps in creating balanced portfolios and managing investment risks effectively.
Section 8. The dot-com bubble. A case study. The dot-com bubble of the late 1990s is a classic example of herding behavior. Investors poured money into internet-related companies, driving prices to unsustainable levels. The belief was that the internet would revolutionize business, leading to massive profits. Herding drove demand for dot-com stocks, inflating their prices. Many investors ignored traditional valuation metrics. The euphoria was driven by the fear of missing out, or FOMO, and social proof. Everyone wanted a piece of the new internet economy. When the bubble burst in 2000, it led to significant financial losses. Many companies went bankrupt, and investors lost billions. The dot-com bubble highlights the dangers of herding and the importance of rational analysis. It serves as a cautionary tale for modern investors. Section 9. The 2008 Housing Crisis Lessons Learned. The 2008 housing crisis is another example of herding behavior. Investors and financial institutions heavily invested in real estate and mortgage-backed securities. The belief was that housing prices would continue to rise indefinitely. Herding behavior drove demand for housing and related financial products. This led to an asset bubble, with prices far exceeding intrinsic values. The crisis was fueled by social proof, FOMO, and reputation risk. Financial institutions followed the crowd, ignoring warning signs. When the housing bubble burst, it triggered a global financial crisis. The consequences were severe, with widespread economic downturns and financial instability. The 2008 crisis underscores the importance of understanding herding behavior. It highlights the need for critical analysis and diversification in investing. Section 10. The 2017 cryptocurrency boom and GameStop short squeeze. The 2017 cryptocurrency boom is a recent example of herding behavior. Investors flocked to cryptocurrencies like Bitcoin, driving prices to unprecedented levels. The belief was that cryptocurrencies would revolutionize finance, leading to massive returns. Herding drove demand for cryptocurrencies, fueled by FOMO and social proof. Many investors bought without understanding the underlying technology. The boom was marked by extreme price volatility and speculative behavior. When the market corrected, many investors faced significant losses. The GameStop short squeeze in early 2021 is another example. Retail investors, driven by social media and FOMO, drove up GameStop's stock price. This was a coordinated effort to challenge institutional short sellers. The result was extreme price volatility and significant financial gains and losses. These examples highlight the impact of herding on modern financial markets. They underscore the need for independent analysis and critical thinking in investing. Understanding these recent phenomena can help investors navigate future market trends.
Section 11. Strategies to mitigate herding. Mitigating herding behavior requires a disciplined approach. Education is key. Understanding market fundamentals and valuation metrics helps in making informed decisions. Continuous learning and staying updated with market trends are essential. Diversification is another strategy. Spreading investments across different asset classes reduces risk. It prevents overexposure to heavily traded assets influenced by herding. A diversified portfolio is more resilient to market volatility and downturns. Critical thinking is crucial in avoiding herding. This involves questioning market trends and making independent decisions. Avoiding reliance on social proof and FOMO can lead to better investment outcomes. It is important to focus on long-term goals rather than short-term market movements. By employing these strategies, investors can mitigate the risks associated with herding. This leads to more stable and profitable investment outcomes. Understanding and avoiding herding is essential for successful long-term investing.